Right now, I mean, literally as we speak, algorithms are trading billions of dollars across the globe in like
Oh,
milliseconds.
absolutely. It's incredibly fast.
Right. We have these complex derivatives, synthetic assets, and digital payment networks that just operate entirely in the cloud. The modern financial system is this hyper advanced digital empire.
It really is.
Yet, sitting right at the foundation of this whole technological marvel, the very institutions that control the global money supply are currently hoarding thousands of tons of a 5,000-year-old rock.
It is, it's the ultimate financial paradox,
Hmm.
honestly. You have the most sophisticated technological infrastructure ever created for moving capital around, and the ultimate backstop for all of it is still just a heavy, inert metal that you have to physically dig out of the ground.
It's like a financial fossil that somehow survived the digital meteor.
Right.
In a landscape where almost every asset is just a ledger entry on a server somewhere, gold remains this bizarre outlier. It has no issuer, it has no national affiliation, and crucially, it has no counterparty risk.
Exactly. If you hold it, you aren't relying on anyone else's promise to pay you.
So today, we're doing a deep dive into exactly that. Our mission for you, the listener, is to cut through all the glittering sales pitches and really understand the fundamental structural role this asset actually plays in contemporary finance.
And it's a great time to do it.
It really is. And we're going to be pulling from a comprehensive research article titled Gold's Pivotal Role in Contemporary Finance, which was published on the Gold IRA Company's bulletin.
Yeah, the author there is Doug Young. He's an analyst with over 20 years of experience in financial markets. He's evaluated dozens of institutions in this space, and he approaches the metal strictly as a macroeconomic concept, a barometer of long-term monetary discipline.
And the timing for this deep dive is just perfectly relevant.
It really is. If we look at today's landscape, it's April 14, 2026. This dynamic is playing out in real time. We're seeing gold rising 2.82% in Tuesday trading, which, by the way, is a very significant single-day move.
For sure.
But more importantly, that market action is happening alongside some really sobering news. Survey data just showed that 9 out of 10 older U.S. workers say inflation is actively forcing them to reshape their retirement plans.
Man, the juxtaposition there is just incredible. The oldest form of money is reacting, while the very real human cost of shifting economic tides hits people's savings.
Exactly. And to understand why it functions as that barometer today, we have to kind of look backward at the structural mechanics of money itself. The fact that a shiny yellow metal became the global standard, it wasn't an accident of history or, just about aesthetics.
Right. It wasn't just because it looked pretty.
No, not at all. It was driven by chemistry and physics.
Well, let's break down those physical properties because they directly translate to its financial utility.
Yeah. So first is its chemical permanence. Gold doesn't corrode.
Right.
If you bury an iron coin, it oxidizes and rusts away into dirt. Silver tarnishes. But you can pull a gold coin from the bottom of the ocean after 3 centuries, wipe away the sand, and it retains its exact mass and form. Second, it's highly malleable and divisible, which means it can be melted and shaped into standardized units of account bars or coins of a guaranteed weight.
So you can basically carry a massive concentration of purchasing power in a very small physical footprint.
Precisely.
But the defining characteristic, the one that anchors its role in economics, is the difficulty of actually producing it. I read that the total amount of gold ever mined in human history could fit into a remarkably small space, like just a few Olympic swimming pools.
Yeah, that inherent scarcity is the linchpin. You cannot simply flip a switch or run a printing press to generate more of it.
Right.
Extracting it requires massive outlays of capital, heavy machinery, physical labor. For centuries, societies gravitated toward it as a medium of exchange, specifically because the supply couldn't be arbitrarily expanded by whoever happened to be in power. It imposed a physical constraint on human ambition.
Which sets up the modern contrast perfectly, because for a long time, paper money was essentially just a warehouse receipt, right?
Right.
A paper dollar was literally a claim check for a specific physical weight of metal sitting in a vault somewhere.
Right. Following World War II, the global financial system was explicitly built on this tether.
Okay.
The major global currencies were pegged to the U.S. dollar, and the U.S. dollar was convertible into gold at a fixed rate. This architecture placed a hard ceiling on the money supply.
Because they couldn't just print infinitely.
Exactly. A central bank couldn't just endlessly print paper notes because eventually foreign governments could demand the physical metal in exchange for those notes.
Yeah.
If you printed too much paper, your national vault would just get drained.
But we ultimately severed that tether in the early 1970s. The world shifted entirely to what we call fiat money.
Right. And fiat money is currency that derives its value not from a physical commodity backing it, but from government decree, legal tender laws, and, well, institutional trust. Once the convertibility to gold was suspended, central banks were free from the obligation to redeem paper money for a fixed weight of metal. The constraint was completely gone.
Okay, but wait, let me play devil's advocate here for a second.
Sure.
Isn't untethering from gold a good thing? I mean, from a policymaker's perspective, it offers a massive tool set. If an economy is collapsing or a pandemic halts global trade, being tied to the physical supply of a metal means your hands are tied. Fiat currency allows a central bank to step in with open market operations.
Yes, that's true.
They can buy up government bonds, inject massive amounts of newly created cash into the banking system, lower interest rates, and actively stimulate the economy to prevent a full-blown depression.
And you're completely right. The flexibility of fiat is absolutely a powerful mechanism for crisis management. It allows governments to smooth out the business cycle and provide massive liquidity when the system freezes up.
Right.
But, and this is a big but, we have to examine the long-term structural trade-off of removing that constraint.
Which is,
Well, when a government gains the infinite capacity to finance its spending through borrowing and central bank operations, without ever facing a hard limit, the incentive structure fundamentally changes. Over decades, the temptation to spend beyond your means becomes practically irresistible.
which leads to debt.
Massive accumulations of public debt, and a persistent, unending expansion of the money supply.
So let's follow that mechanism to its logical conclusion, because expanding the money supply faster than the actual production of goods and services is the textbook definition of inflation.
Exactly.
And inflation is something everyone listening is intimately familiar with right now. It's often described as a silent thief.
That's a good way to put it.
I always think of it like a company issuing new shares of stock. If you own 10 shares out of 100 total, you own 10% of the company. But if the company suddenly prints thousands of new shares and floods the market, your 10 shares represent a much smaller piece of the pie. Your wealth was just diluted.
Right.
When a central bank expands the currency pool, the dollars sitting in your wallet don't change in appearance, but their ability to claim goods and services in the real economy shrinks. Holding a large portion of wealth in cash is like putting a block of ice in a refrigerator that's running just a couple of degrees too warm.
Oh, wow. I like that analogy.
Yeah, it looks solid today, but a decade from now, you're going to open the door and just find a puddle.
It's so true. And this brings us to the critical distinction between nominal returns and real returns.
Break that down for us.
So the nominal value is just the number printed on your bank statement. If you have $10,000 in a savings account, the nominal number stays at $10,000. It feels secure.
Right, the number hasn't moved.
Exactly. But the real return is that number adjusted for the loss of purchasing power. If inflation is running at 5% and your bank is paying you 2% interest, your real return is deeply negative.
Wow.
The purchasing power of that cash is quietly evaporating.
And the research from Doug Young points out something fascinating about this dynamic. Inflation doesn't just destroy wealth uniformly. It actually transfers wealth from one group to another.
Yes.
The people holding cash or fixed income savings get penalized, but borrowers actively benefit.
Right, because the math heavily favors the debtor during inflationary periods. Imagine borrowing $100,000 when that amount of money represents significant purchasing power, say, enough to buy a small house.
Okay.
If severe inflation hits over the next decade, the currency is devalued. When you finally pay back that $100,000, the money you are handing over is worth a fraction of what it was when you borrowed it. The real economic burden of your debt has basically shrunk dramatically.
And the biggest borrower on the planet by orders of magnitude is the government.
Absolutely. Governments in advanced economies are carrying historic levels of public debt. And this is driven by structural pressures like aging populations, rising healthcare liabilities, repeated stimulus packages.
So they have an incentive to let inflation run hot.
Exactly. When sovereign debt reaches these massive proportions, policymakers face an overwhelming systemic temptation to just tolerate higher inflation. It operates as a stealth tax.
Right.
It is politically much quieter to let inflation gradually erode the real value of the national debt than it is to pass massive tax hikes or severely cut public services.
So we have a system where the institutions printing the fiat currency are deeply incentivized to let its value melt over time to manage their own debt burdens. This provides the perfect context for why those same institutions, the central banks themselves, are aggressively acquiring and hoarding gold.
Right.
They are holding the very asset they untethered the rest of us from.
Yeah, because central banks treat gold as a premium, low correlation asset.
What does that mean exactly in this context?
Well, in a standard reserve portfolio, a central bank holds a mix of foreign currency deposits and sovereign bonds. The value of those paper assets is deeply intertwined. If there's a synchronized global downturn or a crisis of confidence in a major fiat currency, those assets tend to decline together.
Because they're all tied to the same fiat system.
Exactly. Gold operates outside that financial ecosystem. Its price movements are not dependent on the earnings of a corporation or the fiscal health of a foreign treasury.
I often wonder about the psychology behind this at the institutional level. Are these central bankers buying thousands of tons of metal because they're secretly prepping for some global financial apocalypse? Or is this just standard bureaucratic risk management?
It leans heavily towards strategic risk management, particularly when you factor in the modern geopolitical landscape. We're operating in an era where the financial plumbing of the world is frequently weaponized.
Ah, right.
Look at the mechanisms of international finance, cross-border capital controls, payment networks like SWIFT, economic sanctions. If a nation holds its sovereign wealth in the digital currency of another country, they don't actually hold it, they just have an IOU on someone else's ledger.
Meaning with a few keystrokes, the host country can freeze those assets, restrict access, or seize them entirely during a diplomatic dispute.
Yes, foreign-denominated reserves are only as safe as the political relationship between the two nations. Gold offers an immediate bypass to that vulnerability.
Because it's physical.
Because it's a physical commodity that can be stored domestically in a vault within your own borders, and because no foreign government issues it. It provides absolute sovereign immunity.
Wow.
It's essentially an insurance policy against the failure of trust in international counterparties. Large institutions utilize it as a tactical diversifier during stress episodes to ensure a portion of their national wealth remains completely untouchable by outside forces.
Okay, so we've mapped out the macro environment, how nation-states and massive institutions utilize this asset to offset systemic risk. Let's zoom in on what this means for the individual listener.
Yeah.
Translating these mechanics into a personal financial toolkit requires a really clear understanding of what gold is not. It is not an engine for compound growth.
No, not at all. The concept of compounding is essential to wealth creation in traditional markets. If you buy shares in a successful corporation, that company takes your capital, creates a product, generates a profit, and reinvests that profit to grow the business, or pays it out as a dividend.
Real estate provides shelter and generates rental yield.
Right. But gold does none of those things. It is inert, it pays no interest, it has no management team trying to increase its market share, and it generates no cash flow. Its utility in our portfolio is strictly as a preserver of capital, a store of value across long time horizons.
And if someone decides that capital preservation is a goal, the actual mechanics of acquiring exposure come with very distinct trade-offs. The most obvious method is physical ownership, buying the actual coins or bullion bars.
Yeah, and physical ownership eliminates counterparty risk entirely. The asset is fully in your possession, but the trade-off is entirely logistical.
Right, you have to store it.
Storing large amounts of value requires physical security safes, secure facilities, and specialized insurance. Furthermore, when the time comes to liquidate the asset, a buyer will often require the purity and weight to be professionally verified, adding friction to the transaction.
Which is a huge hassle.
Oh, yeah.
So the financial industry created paper gold, like exchange-traded funds, to solve that friction. You can buy shares in a fund that holds the physical metal on your behalf.
Exactly. An ETF removes the burden of securing a heavy safe and arranging insurance. You gain exposure to the price movements of the metal with the ease of trading a stock.
But there's a catch.
There is. This reintroduces counterparty risk. You're trusting the management company to secure the underlying asset. You're paying ongoing management fees which slowly eat into your position, and you are completely reliant on the integrity of their digital ledger.
And then a third avenue outlined in the research is investing in mining equities, buying the stock of the companies operating the heavy machinery to pull the metal out of the earth.
Yeah, mining equities add layers of operational complexity and volatility. When you buy a mining stock, you aren't just making a macroeconomic calculation about the monetary supply anymore. You are making a localized bet on corporate competence.
Right.
You're exposed to the management's capital allocation decisions, the rising costs of diesel fuel and labor, and the geopolitical stability of the specific region where the mine is actually located. A company can mismanage a perfectly good gold deposit and see its stock price plummet even while the global price of gold is rising.
So looking at these options, I have to point something out. There is a significant hassle factor inherent in this asset class.
Oh, for sure.
Physical requires heavy security, ETFs bring management fees, and mining stocks introduce corporate risk. When you compare that to the frictionless experience of opening an app and buying a broad stock market index fund, it almost feels archaic. Isn't this just a massive headache compared to simply buying a stock index fund?
That hassle factor is a completely valid critique. And really, it underscores the purpose of the asset. A broad stock index fund is a frictionless way to capture the innovation and economic growth of human enterprise.
Right.
Gold is just a standardized hedge against the dilution of currency and severe systemic instability. The decision to take on the logistical friction of precious metals depends heavily on an individual's specific time horizon and their personal tolerance for relying entirely on digital fiat-denominated systems.
That makes a lot of sense. Now, our source material from Doug Young also introduces a secondary element to this toolkit: silver.
Yes,
Silver is often mentioned in the same breath as gold, but the market mechanics driving its price are remarkably different.
they are very different. Silver shares a long history as a monetary metal, functioning as a medium of exchange alongside gold for centuries. But in the modern economy, it has developed this profound dual identity due to its physical properties.
Of industry, right?
Yeah. Silver is one of the most electrically conductive metals on Earth, making it completely indispensable for modern industrial applications. It is consumed in massive quantities in the manufacturing of electronics, medical devices, and photovoltaic cells for solar panels.
And because it is continually consumed by industry, its price is highly sensitive to the broader economic cycle.
Yes, the industrial demand makes silver far more volatile. If the global economy is booming and manufacturing is scaling up, the demand for industrial silver spikes, often driving its price up aggressively.
But on the flip side,
Exactly. Conversely, during a severe recession, when manufacturing slows down, the industrial demand collapses, and silver can suffer dramatic price drops, even if its monetary properties remain totally intact.
analysts often track the gold-silver ratio, right? The mathematical calculation of how many ounces of silver it takes to purchase a single ounce of gold. It acts almost like a diagnostic tool for reading economic sentiment.
It really does.
If the ratio is very high, it suggests silver is underperforming, potentially signaling an industrial slowdown or widespread risk aversion. It's basically a way to measure the tension between industrial growth and monetary fear.
It is a fascinating metric. Investors use that ratio to identify relative value, shifting allocations between the two metals based on where they believe the economy is within the business cycle.
Yeah.
But fundamentally, treating silver simply as cheaper gold completely ignores the complex industrial dynamics that dictate its price action.
So bringing all of this together, the analysis from Doug Young really provides a clear structural view of precious metals. Gold isn't a magical wealth creation engine. It is a globally recognized, standardized commodity functioning as a hedge.
Right.
Its defining superpower in contemporary finance is its lack of counterparty risk. It is the only financial asset that does not require another entity to keep a promise or maintain a ledger for it to retain its value.
And we definitely must highlight the source's explicit disclaimer here. The material covered in this deep dive is strictly for educational purposes and should not be construed as financial advice.
Right.
Engaging with precious metals involves real risks, including the potential for significant price volatility. Listeners should evaluate their own financial objectives, assess their individual risk capacity, and consult with licensed professionals before making any allocation decisions.
Absolutely. And we want to acknowledge Doug Young's comprehensive research for laying the groundwork today. As a former financial director, he brings over 16 years of experience to his analysis.
Yeah, his insights were great.
For those wanting to review the data, evaluate the various exposure methods, or explore the institutional metrics themselves, you can find the factual resource guide at goldiracompaniescompared.com.
Highly recommend checking it out.
We'll include a direct link to that in the notes. Again, the resource is goldiracompaniescompared.com.
To close out our analysis, consider the broader trajectory of the global economy. We just explored how the primary utility of gold lies in its physical existence and its absolute independence from financial institutions.
Yeah.
As society accelerates toward a completely cashless, purely digital framework, a world where every unit of purchasing power you possess is merely a digital entry on a centralized server, requiring uninterrupted electricity, constant internet access, and the continuous permission of a bank just to transact.
Wow, when you put it like that.
Right. Does a 5,000-year-old, inherently scarce piece of metal eventually become the only truly private sovereign asset you can actually hold in your hand?
That is a phenomenal tension to leave hanging. As the entire financial ecosystem upgrades to faster algorithms and more complex digital ledgers, the ultimate hedge against all that complexity remains a fundamental element of the Earth. We hope this deep dive gave you a clearer lens on the mechanics beneath the headlines. Keep questioning the systems around you, keep expanding your toolkit, and we will catch you on the next deep dive.